Hi everybody, this is Darren Chu here. This is the fourth episode of Grow My Portfolio with me. And today I'm going to update my portfolio after 1.5 months. And also that I have added in a new counter called ParkwayLife. And I'll share with you why I buy these REITs and provide an update on my portfolio current status. As of 17th of February, the stock portfolio currently have $9,000 inside, as I just top up additional 2,000 in middle of February. So currently, I've added a new position which is called ParkwayLife due to their certain price weakness in the counter. And it is one of the 5 REITs that I want to build in this portfolio. Why ParkwayLife REITs? So ParkwayLife have a 4th quarter business update in late last month. And let's look at the result as they have delivered another record DPU for financial year 2021. Means that this is another new record high DPU for ParkwayLife since the IPO more than 10 years ago. From the consolidated financial statement, you can see that the NAV have actually increased over the past 1 year from $1.96 to $2.34. And also the price to premium have also increased from 97% to plus 116%. But that's based on the price of $5.13. That's at the end of 31st of December. Currently, their price is much lower than this, but nevertheless, their price to NAV is still close to 100% now. And some of you will feel that this is too expensive for the REITs based on their premium to NAV. But however, do take note that this REITs, based on my opinion, you'll constantly trade at a high premium due to the nature of the REITs itself. And what do I mean by that? Let's look at what is so unique about this REITs. Now let's look at the REITs portfolio. The REITs currently have a portfolio of 2.29 billion. It is not considered a big REITs in terms of size. But however, look at the number of property they have. Currently, they have 56 properties, where 3 hospitals in Singapore, 1 medical center in Malaysia, and the rest are all in Japan. And the main revenue contributor is mainly Singapore, which contribute about 58.9%, and followed by the rest is from Japan, 40.9%. The contribution from Malaysia is actually very negligible. And let's look at the weighted average lease to expire. It is 17.31 years. It is a very, very long lease when compared to the rest of the REITs in the market. And this indirectly means that you will have more of a rental income really for the long term, which is more than 10 years. And what's so unique about this REITs is for the renter, 98% of them are with downside protections. That means that your rental income unlikely to drop. If the rental income unlikely to drop, means that your dividend will unlikely to drop. And they always come with the escalating factor, some inside built to the long lease. Indirectly means that your rental income will only go up over the long haul. And this explains why the REITs will constantly trade in high premium to the NAV. As every REIT investor invests in this REIT, they will expect that their dividend will only go up year on year. Let's look at their track records. You can see that their dividend have grown by 122.8% since IPO. That is at 2007, which is before the global financial crisis. What does that mean? This means that when you buy this REIT since IPO, your dividend actually have more than double. This will explain why your share price will definitely also will be more than double when you buy this REIT since IPO and hold it to today. And do take note, these REITs have grown through 2 major crises over the past around 15 years, which is the 08-09 global financial crisis, and also the COVID-19 happened in last 1 to 2 years. Despite these 2 major events, the DPU keep on go up. And this makes this REIT so unique that if based on my understanding, it is the only REIT now in Singapore that have been through these 2 major crises and the dividends will continue to go up. However, I have some concern about this REIT also. Is not everything are always rosy. One of the key concerns is the size of the REIT, and this REIT is pretty small compared to the other bigger REITs in Singapore. And although they have a very healthy gearing of 35.4%, but due to their size, their debt headroom is up to 45% gearing is only 410 million. And very unlikely they will use up the debt headroom all the way to 45% also. And because of the debt headroom of 410 million, this means that they do not have the ability to buy another hospital in Singapore with just purely by doing debt financing. And they may need to do a massive equity fundraising if they were to buy a hospital in Singapore for them to grow bigger. However, with this debt headroom, it's good enough for them to continue to buy nursing home. As a nursing home maybe costs about 20 to 30 million on average. So it's more than enough for them to buy quite a fair bit of nursing home. The next question is, where are they going to continue to buy nursing home? Will it be continuing to be in Japan, or would there be a third country they're going to go to? And this is where I'll be interested to know what is their long-term plan for that. They have been constantly mentioning they're trying to build a third key market for them to continue to grow. And this is a one that I'll be monitoring on Parkway Life to look at actually what will be the third market they're going to go to. As they are a healthcare REIT, the main thing is either a nursing home or hospital, and hospital will cost quite a fair bit. So if you're looking at nursing home, most likely they will have to go to a developed country and they have an aging population where Japan just nice fit them. But what will be the third market they need to go to? And this is something that we need to monitor if you are invested in Parkway Life, and this is something you need to take note of. And also one thing a lot of investors invest in REITs is they are looking at quarterly dividend. However, do think gone will be the day that REITs pay dividend quarterly. More and more REITs are shifting to pay their dividend from quarterly to semi-annual due to the change in reporting implemented by SGX, where a company only need to report every 6 months instead of doing quarterly earnings report. And thus, Parkway Life will also be shifting their quarterly dividend payout to semi-annual. For those that depend on cash flow, dividend from REITs investing, do think that your dividend waiting time will be extended from 3 months to 6 months going forward from this year. Let's look at the price chart performance of Parkway Life and why I buy Parkway Life recently. As you can look at the past 2-year chart, they have been trading well above the 200 MA, and the trend is on an uptrend. And lately, there is a drop, pullback in practically all the REITs in Singapore. And because of that, I take the opportunity to start a small position on Parkway Life. And let's look at the longer term trend. You can see that the Parkway Life longer term trend is still on the upside, and you can see that it's still going up. And however, by looking at that, you can see the volatility actually have increased over time. The price swing for Parkway Life actually have increased, maybe because the market has become more and more volatile going forward. So this is a summary of my stock portfolio as of 17th of February. Currently, I holding 3 REITs and also 3 US stocks. And I still got 3,000 plus of cash parking inside the money market fund, waiting for opportunity to come by in the near term so that I can deploy this cash to the market. Now let's look at my unit trust portfolio as of 17th of February. The current invested capital is 7,000. Initially start with 5,000. I have do a monthly dollar cost averaging of 2,000 at the first week of the month. And you can see that all the 5 funds are negative due to the market volatility recently. As I mentioned, that this portfolio is a very aggressive portfolio, which have a volatility of more than 15%. And currently the portfolio have dropped about 4.87%. When we compare to end of January, it have dropped 8.17%. The losses have reduced, although the market, especially the market, didn't really recover. But because due to dollar cost averaging, it have actually bring down the losses in terms of percentage. And let's look at the year-to-date return. If you were to compete, including the dollar cost averaging figure, the year-to-date is down about 3.44%. And I'll still continue to do dollar cost averaging to this portfolio in the beginning of every month. Until the portfolio have grown to a certain size, then I may need to make a necessary fund switch along the way, or if there is any drastic change in market condition. And I'll keep everyone updated on this. And that's all I have to share with you today for this portfolio update. And if you feel that this have benefit you, Do remember to like and share this video, and also do remember to leave your comment below to let me know what you think. And also do remember to subscribe and press the notification button so that you'll be notified on my next video. I shall see you in my next video. Bye bye.